Hi everyone, welcome back to the Navigant Credit Union Broadcast Center. I'm GoLocal News Editor Kate Nagel. Thanks for tuning in for the Wednesday afternoon news and politics show. Not much more news than the stock market. I'd like to welcome John Kuczmarski with Efficient Capital Strategies. Thanks for coming back to give us the take on the market and give us the just big sense before we go into the Fed rate hike today, but where we're at December 18.
Thank you, Kate, for having me. Yeah, it's been a wild ride for the markets. We're down 15% for the quarter in the S&P 500, down 9.5% for the month in December alone. It's the second worst month for the market since 1931, when the market was down 17%. So we do have some margin between then and there, and now we're down around 6.5% year to date. Coming from up 9.75 the last week, third week in September. It's been a very shocking ride in the market.
Well, once it started to get a little wild, we wanted to bring you in with your expertise. And again, as a disclaimer, this is just your assessment of the situation, and this is not in any way, shape, or form any investment advice.
Absolutely. And, financial advice is not one size fits all. If you do hear something today, please consult with the financial professional before acting on it. See if it's suitable for you. The markets are in the news. I'm more than appreciative to help out and give a take, but do not interpret any of this as investment advice, please.
So let's talk about the big news today. The Fed raising a rate hike again for the fourth time in 18.
Yes, yeah, absolutely, yes. It's been 4 times in 18, yes, and the 7th time since we started in December of 2015. 25 basis points each time. In addition, the Fed has been going full steam with their balance sheet runoff plan, and the balance sheet is running off at $50 billion a month. So we are in a process of policy normalization and have been since 2015.
And how do the markets react today after this hike?
The markets have been really funny lately, especially with the Federal Reserve. They're kind of looking to the Fed to be their white knight in shining armor. Is what I'm looking for, and they got a big surprise today. The Fed exists for emergency situations in the market. The Fed has been ultra accommodating for 10 years. All right, we started off before the financial crisis. We had rates at 5.25%, and we had a balance sheet at $850 million. Then we had the financial crisis. To survive the financial crisis, rates went down to 0 in 2008. And that wasn't enough. So the Fed had to go into the open market, buy mortgage-backed securities and treasury securities, and expanded the balance sheet to about $4.5 trillion, creating which is kind of known as printing money. And now we're in a situation where the Fed and Jay Powell, I give him a lot of credit. He's preparing for an emergency down the road. That I'm not saying a specific emergency, but it's great to have a cushion here. We're raising rates because we're not trying to sabotage the stock market. We're trying to prepare for the any future event that could happen, a black swan event. It will give the Fed leeway to cut rates and to add to the balance sheet. So Jay Powell's been in a rock and a hard place. Donald Trump has been bashing him every day, all right, on Twitter and everything else. And this is a guy he appointed, and I think
he's his guy.
And yeah, this is his guy, and he's done a phenomenal job. I really couldn't applaud him more. And a lot of people will say, "Hey, look, he's raising rates and the market's going down." But look, the Fed does not exist to impact stock markets. It exists to create monetary stability and full employment.
And you talk about today as perhaps with Powell's move, preparing, making sure there's some stability, preparing for something in the future. Of course, the big R, the little R is on the tips of everyone's tongue. Obviously, we've seen a booming economy for the last months, never mind the markets, but having seen a very tumultuous last couple of months. But has there been that talk today? Is, again, that fear that we're seeing a slowdown? Yeah,
absolutely. There are the slowdowns actually. Has shown itself a little bit more overseas in terms of we've seen some 0 to 1% prints in Japan, in Europe, So we are getting close to that zero bound where we enter negative territory of recession. I think it's pretty certain that 2019 will be known what is known as an earnings recession. So meaning stock market earnings will contract. I mean, U.S. equity market earnings will contract on a year-over-year basis. Last time I was here, I said that we wouldn't get below 2% in the United States. I'm going to move that down to 1.5. All right, but I don't think this is going to be a Main Street event. I really believe this is a repricing of financial assets because credit is changing. And really one of the funniest parts about 2018 is there's not an asset class in the world that's up over 5%. It's really been remarkable. Bonds are down, stocks are down, commodities are down, and it's really a reflection of the global central bank balance sheets, peaking and starting to contract. And and I love Jay Powell because we're getting away from the Fed being the end-all be-all in markets.
And I know the last time you were in here too, it was, if you're talking to investors out there, it really depends on their own individual strategy in terms of looking at the year ahead and what your own financial needs are, and to talk with your financial advisor about how to kind of weather this potential storm.
Yeah, I mean, everyone is specifically different, and I mean that in the most honest way possible. Some people are very astute to what's going on with their investments. Some people, they don't even know the markets has sold off. It depends on what your goals are, what your risk tolerance is, what your time horizon is, and that's why just blank, financial advice just doesn't work. And it really doesn't. But look, markets could get very rough. We discussed this last time when we were here 2 months ago, when markets were higher. But at the end, I don't think the economy is gonna fall out. But I do think that the people that don't respect risk right now are having a very hard time. And I know this goes to our next segment, which we want to talk about, which is hedge funds.
Yes. Now, before we get to hedge funds, though, I do want to back up a little bit to the president and his sort of interjecting with Federal Reserve policy and tweeting and opining. Have we really seen this with the president like this publicly and in such a manner? And does he run any risks of his interjection, if you will? I mean, because this is his bread and butter. This is his livelihood. He's a markets guy.
Well, he's a real estate guy. So all real estate guys love low interest rates, all right? Because you can build more and borrow more.
Yes.
All right. So back to what was your question again?
Just about his interjecting as the president of the United States for something that's supposed to be an autonomous,
Absolutely.
relatively autonomous body.
When the Federal Reserve was created, it was created like a couple days before Christmas in, I think, 1911. It was created to be an independent entity that exists outside of politics. And Donald Trump has really crossed I don't know if you call it a red line, but an unconventional standard where he has really politicized the Fed. The Fed's just trying to do what's right for the economy. They're not central planners. They're not the stock market's best friend. They're here to create financial stability. And especially today, there's so many investors I know. They're all thinking the same thing. They're all like, when is this going to end? When do we jump back in? When does the Fed save the day? The Fed might not save the day. The Fed's going to probably raise rates again next year in June and in December. That's what the market's pricing, and that is kind of what Jay Powell said today. So everyone was expecting this big rescue today, and we didn't have it. The Dow was from highs of the day to lows of the day was 900 points. So obviously there was a big expectation that Powell would be dovish, and markets would sell off. But look, for most people at home, this is meaningless. It's not going to change their day-to-day basis. But to understand what's going on, if that makes you feel better, if that makes investors feel better, that's what happens. But look, keep your long-term goals in mind. But also look, it's a risky environment. I mean, we're down 15% in the quarter. That annualizes out to 60%. That's like what 2008 was. I don't think, where markets went down 55%. I don't think we're in 2008 by a long shot, or I don't, and maybe the worst is over. But I don't think investors should be, it just depends on the investor. If you're really worried about the stuff, work with your advisor. They'll come up with a plan. But most investors, by the time this decade ends, 2021, it wouldn't have made sense for them to make an adjustment.
So let's talk about something that else has been in the news recently, and this is sort of the hedge fund beating, if you will. Your thoughts about that, and let's talk a little bit about our favorite acronyms, FANGBAT, hedge fund hotels.
Yeah, so Kate just learned what a hedge fund hotel is. A hedge fund hotel, no, I'm sorry. It's a stock that that most of the hedge funds own. And a lot of what's happening right now in the market is that there are 8 particular stocks that are very widely owned by hedge funds. Facebook, Apple, Amazon, Netflix, Google. And that's the American version. And BAT, which is the Chinese version, which stands for Baidu, Alibaba, and Tencent. Those stocks are high beta names, high growth names. And they have been really a very crowded trade that's been unwinding very sharply. And hedge funds are leveraged. So, they may have a dollar, $10 in assets for every dollar they have in equity. So, a 15% sell-off to them could be everything. So that's why, a hedge fund investor has to be more worried about gyrations in the market than, the average retail, retirement investor who's planning for 10, 15 years down the road.
Anything else you want to share with folks? That we gave the broad market overview, talked about the Fed today, talked about where hedge funds stand. You gave us a little insight into 2019, but anything else you want to share with viewers?
Well, a lot of it, 2019, is off to, an uncertain start. And, that's what kind of happened in the fourth quarter. We're repricing, thinking things was going on. I think there's a lot of uncertainty about trade, global trade, tariffs. I just heard a story about a commercial mariner that I know in Rhode Island. He started in Asia, had to set adrift at sea for 15 days without even knowing where they were going. And it turns out they were supposed to go to California, but wound up going to Poland. So yeah, there's a lot of uncertainty. I mean, obviously that's one anecdote, but there is a lot of uncertainty going forward into 2019, a lot more so than there was going into 2018.
Well, we hope we certainly can get you in here to really break it down for folks. When they see these headlines, see how the market's behaving, I think you break it down quite concisely for our viewers here in the studio. So John Kuczmarski with Efficient Capital Strategies, thank you for taking the time to come in. And don't go anywhere. We're going to tack from finance to education here in the state and the Navigant Credit Union Broadcast Center. We'll be right back.